So today we are going to continue our chapter number 14, unit 2. See, in the last session, we discussed about the term NBFC. We discussed about the definition of NBFC, like how you can identify, like how we can classify a particular entity as an NBFC. Also, just I want to highlight one thing. If you can now join the session by logging onto the BOS portal, and over there you can see LVC for 2027, and then join Zoom. So you have an option to join the Zoom meeting right now instead of last 15 minutes. So please go to the BOS portal, you log in with your credentials, go for LVC May 27, click on join Zoom, and you will be able to join this session. Okay. Again, go to the BOS portal, log in with your credentials, go for the LVC May 27, click on the join Zoom, and you will be able to join the Zoom session, this one. Okay. So let's discuss now. We were discussing about in the last session about the term NBFC. We discussed about the definition of NBFC. Okay. From where the term and the definition of NBFC is coming into the picture, and we discussed about the principal business. Remember 50-50 criteria, principal business criteria. We discussed that in our previous session, that how principal business comes into the picture, from where it comes, and what is required to be done with respect to the principal business. We also discussed, like, glance through the exemption given with respect to the NBFCs. Okay. So that was something we discussed with respect to the NBFC in previous session, like principal business criteria, definition, RBI Act and its section, and a bit of exemptions to the other NBFCs which are governed by the other regulators. I hope everyone is clear with that. Any doubt in that particular area before I proceed? You can ask, unmute, and you can ask your doubt. Any doubt with respect to whatever we have discussed till now? No? Great. Okay. If no doubts, then we'll proceed and discuss one very important topic now. Okay. We are going to discuss about beyond the NBFC, term NBFC. Now we will go to the operational side of the NBFC, and that is very important. Why operational side? Reason, because now based on this, we will be able to understand that how NBFCs are classified, like various NBFCs are classified, and how these NBFCs are required to operate. Okay, like based on their layer system and based on the various classifications. For that, earlier, I'll just provide you a brief background, what was earlier and what is now. So earlier, there was a scale-based regulations. Now, if I talk about, just give you a summary, there was a 2016, okay, directions which were deposit accepting and systematically important non-deposit accepting NBFCs. They were very old direction. Okay, I'll say very old. Very old direction for NBFC, 2016. Those directions changed in 2023. And in 2023, SBR was introduced. Now, what is SBR? SBR stands for scale-based regulation. Okay. SBR stands for scale-based regulation. In 2023, RBI introduced scale-based regulation for NBFC. That means now NBFCs were classified based on the scale. And when I talk about this scale, the scale was upper layer, base layer, then middle layer, then upper layer and top layer. There were 4 scales, and we will go through on those scales in some time. Don't worry. But those were the scales that were classified, and those were the scales that were provided. Okay. And SBR also provided a lot of different things with the operational perspective, with respect to the prudential norms, with respect to the capital adequacy, with respect to a lot of things that was provided in case of SBR. That was part of one single scale-based regulation. Okay. That was part of one scale-based regulation framework that was there in 2023. Now, what happened after 2023? In 2025, basically, November 25, We'll come to the November 25. November 25, something different happened. The scale-based regulation got separated. A new set of regulations came into the picture. Okay, I'll just explain again. Just give me a minute. So we started with the, just for the understanding, we started with the 2016 directions. Those were the very old directions. Okay, these 2016 directions, they were replaced with scale-based regulations, SBR 2023. They provided a lot of details with respect to, you can say, registration, capital adequacy, provisioning norms. A lot of details were there in that scale-based regulations. Then we will come to the present scenario. In November 2025, okay, November 2025, to be precise, 28 November 2025, this scale-based regulation was, distributed or bifurcated into various directions. Now, earlier you were having a scale-based regulation 2023. Now we have a various regulations of 2025, but they are kind of, breakup of the scale-based regulation. Okay, it's if you'll see the concept side, pretty much everything is same with the scale-based regulation. We will also see a bit of small changes and amendments in that area, but majoritarily everything is same. Now what happens is these new directions, that is 2025 directions, which is a breakup from the scale-based regulation, has came into place. Like for example, NBFC, prudential norms on capital adequacy. Okay, earlier there was a NBFC registration and exemption regulations. So there are various regulations, and if I just show you on the directly RBI portal itself. So this is the RBI portal. Okay. Now, if you see, these are the various regulations which were issued in November 2025. Okay, and these are kind of a breakup of the scale-based regulations. So earlier, this entire set of regulations were part of one single scale-based regulation 2023. Now they have been bifurcated into registration, into branch authorization, into governance, prudential norm for capital adequacy, then acceptance of the public deposit, credit facility, credit card. A lot of bifurcation has happened. Simple example, asset liability management, income recognition, asset classification, provisioning, the prudential norms which I'm talking about, willful defaulters, financial statements, know your customer. A lot of things are there. Okay, and again, separate regulations for the CIC, standalone primary dealers, mortgage guarantee. I'm just giving an overview. Now we have a set of new circulars which were issued, or directions which are issued on 28th November 2025. So earlier scale-based regulation of the earlier version of the scale-based regulation of 2023 was removed, and these directions were brought into the place. Okay, and when I talk about these directions that are brought into the place, these are now chapter-wise, subject-wise separate direction. One for registration, one for your prudential norms, one for your capital, one for asset classification. Okay, like that way they have a separate direction. Unlike earlier, there was one single direction which was covering everything. They broke into various sections. Now, what difference it will make? Okay, now, and why it is important for us to understand. It is important for us to understand reason, because when you are now quoting, like, which regulation it is, you have to make sure you are quoting the correct name of the regulation, because each and every regulation has a different name. Like, let's say, for example, registration requirement. So registration requirements are coming now from non-banking financial company registration, exemption, and framework for SBR directions 2025. Okay, that's a name for the registration, and this is how the registration works. So these direction covers framework for scale-based registration, exemptions, everything. Okay, Then you have a capital adequacy. So these are non-banking financial company prudential norms on capital adequacy. They cover the elements of tier 1, tier 2, deferred tax asset and liability impact, leverage ratio, risk weighted assets. So these all things are coming from this direction. So now, because there are multiple directions, you need to be aware of which directions are catering to which particular area. Okay, and we will go in a sequence. Now, what is the sequence that we are going to follow right now is simple. When I talk about 2025, we will start with the first, your registration directions. Okay, we will start with the registration, because this registration directions will provide you what is scale-based classification of NBFC. We will discuss something called exemptions of NBFC, who are required to get registered and who are not required to get registered. And there is amendment also that we need to discuss. Okay. Then after discussing these two categories, we will go, or after discussing these two important areas from the registration part, we will proceed and we will discuss with respect to now the capital adequacy and the capital requirements, or the capital, you can say, directions. So capital adequacy directions. Now these capital adequacy directions will help us to understand that minimum capital requirements. This will include your net own funds also, including net own funds. Then we will understand the components of tier 1 and tier 2 capital. We will see that how it is being different for the base layer, middle layer, top layer and upper layer. Then we will proceed, we will talk about something called risk weighted assets. Okay, how to calculate what are the risk weighted assets. Okay, and how we should approach to that particular part. That is something we will learn from the capital adequacy. Once we cover with the capital adequacy, we will proceed toward then the income recognition and asset classification and provisioning directions. Okay, income recognition, asset classification and the provisioning directions. As the name suggests, it will help us to understand what are the asset classifications, how asset is classified, how income is recognized. Okay, that is income recognition. Then asset classification. Then provisioning requirements. These all things will be understood from this set of directions. Okay. Then in the subsequent part of the session, in the subsequent sessions, we will deep dive into these auditors report, auditors reporting responsibility under NBFC norms and all those things. And meanwhile, in between, we might touch upon something more onto the financial statement a bit, or some other different directions which may come up a bit. Okay, but these are the primary three directions. First of now we will focus upon. Okay, so any doubt till now with respect to understanding how these directions are working? Any doubt? Because it is very important that what we are discussing and how we are discussing. So the substantial change, if I talk about between the 2023 scale-based regulation and the 2025, is just the breakup. Earlier, there was a single direction scale-based regulation framework 2023. Now you have a category wise different directions. So it has been uh, divided into multiple different directions, segments, you can say. These directions were introduced in November 2025. So accordingly, this will be applicable for May. Yes, May 27, it will be applicable. Yes, you can refer to the RTP also over there for the even November 26. You have been given the list of updates which are applicable to you. Basically, this will get covered over there also. So the RBI portal, yes, I disclosed that on the RBI portal that how various breakups, various different directions are there. Any other doubt? Any doubt? See, it's very important because you need to understand this is the starting point. Because if you lost somewhere between, like on the start itself, you will not be able to understand where we are going, then the discussion part. That's why it's very important to understand like where from what is coming and how it is coming. Okay, now the understanding of the scale based regulation. See, if I talk about the concept which was there in the scale based regulation 2023 and which is there now in 2025, concept is same, scales are same. If you pick up your module, 90 to 95% things are going to be on the similar lines, because the concept is going to be the same for kind of that the NBFCs are divided into those scales only. There is nothing new from the scale side. A bit here and there amendment is there. We will discuss that with respect to the registration part. But apart from that registration provisioning and your this capital part, there are few changes here and there, but the concept is going to be same. Concept is not going to differ. Okay. Now let's understand the scale based regulation. See, when I talk about scale-based regulation, we will as of for now we will call them the scale-based regulation only, because the concept is going to be the same. That their NBFCs are divided based on the scale, and these are the NBFC base layer, NBFC middle layer, NBFC upper layer, and the NBFC top layer. Okay, so there are four layers: base, middle, upper, and top. All the NBFCs which are registered or which are not registered in India are divided into these four categories. Now, what is the purpose of dividing them into the four categories? Because based on the scale, based on the base layer, based on the middle layer, the regulation will differ for them. What they need to comply with, how they need to comply with, they will differ. The base layer, smaller ones, will have a lesser regulation to comply compared to the upper layer, and the top layer, they will have a higher regulations to comply. That's where the term scale based regulations comes into the picture. That means according to the scale, the regulation will be applicable to you. Okay. Now, when I talk about NBFC base layer, NBFC BL, we usually, like, if we have to write base layer, we will write NBFC BL, base layer. Okay. These are the NBFCs which are non-deposit taking NBFCs and have the asset size below 1000 CR. Again, non-deposit taking NBFCs below the asset size of 1000 CR. Or you can have that NBFC who are into peer-to-peer lending, who have NBFC which are account aggregators and non-operating financial holding companies. Okay. Or NBFC having a type 1 certificate. NBFC holding certificate of registration as a type 1 NBFC. If any of the category of NBFC is there, they will fall under the base layer. Primarily, if I talk about base layer, We will also take the notes along with this scale based regulations. And the first part is base layer, which is NBFC BL. Okay. Now, when I talk about NBFC BL, the NBFC BL criteria should be non-deposit accepting, and asset size less than 1,000 crore. These two conditions should be satisfied. Plus, or like, if the NBFC is into P2P, P2P NBFC, NBFC is into your account aggregator, we call it NBFC AA, account aggregator. Then there is a non-operating holding financial company. Okay. So, non-operating financial holding company, NOFHC, NOFHC, and type 1 NBFC. If these are the NBFCs, it will fall under the category of base layer. Now, when I come to type 1, this is where the amendment comes into the picture. So this is amendment, very important part. And as of now, we will do a star mark, because this we will understand in some time. As of now, what is type 1 NBFC? Okay. So that is base layer. When I talk about middle layer, all deposit taking, irrespective of the asset size. The moment you start taking deposit, you become middle layer. Okay, irrespective of your asset size, you become middle layer. Okay, if you are non-deposit taking an asset size more than 1,000 crore, because less than 1,000 and non-deposit is base layer. So if you are still non-deposit and if your asset size increase 1,000, you go for the middle layer. Plus, standalone primary dealer, infrastructure debt fund, non-banking company, IDF, NBFC, core investment company, housing finance company, non-banking financial company, infrastructure finance company. These are middle layer by default. So this is based on the activity. Activity wise classification. And this is your based on the asset size or deposit plus asset classification. So there is two type of classification which will help you to segregate between the layers. Okay, again, classification based on your activity and classification based on the asset size and deposit. Okay, two layers of classification. Everywhere, like in the base layer and the middle layer, you will find this kind of two type of classifications. Okay, so let's go to the notes and we will write this middle layer. And in middle layer, deposit taking, so NBFCD means you are taking the deposit. NBFC, okay, non-deposit taking, but asset size greater than 1,000 crore. Then NBFC, standalone primary dealer. NBFC, infrastructure debt fund. I think it's IFD, if I'm just NBFC IFD, IDF, sorry, infrastructure debt fund. NBFC, infrastructure finance company. Okay, and NBFC CIC. That's a core investment company. So these are the part of your middle layer. Simple. Now let's understand what goes into the upper layer. Upper layer are the specifically identified NBFCs. Again, there is a way to identify the NBFC in the upper layer. So there is no straightforward criteria. There is a paragraph 24 of these directions, which helps, which lays down the criteria to identify which NBFCs will be into the upper layer. Okay. And if I talk about these criteria, upper layer, this is criteria kind of, a lot of things are being considered over here. But recently there was a bit of change that I want to highlight with respect to this upper layer. Okay. And this change has been brought into recently, which is that earlier, if you see, with the 2023 regulations, scale-based regulations 2023, there was a classification of the upper layer based on certain criteria. Like you will see the scoring, everything, a lot of things. Now what they are doing is, now the classification is NBFC having asset size of 1,000 crore and above as per the latest audited balance sheet. That will be NBFC upper layer. But there is a transition plan given that how you will put a NBFC from the middle layer to the upper layer. Okay. But if you have an asset size 1,000 crores or 1 lakh crores or more, not 1,000, 1 lakh crores or more, upper layer. Simple. There we are not discussing about any asset classification or any deposit, non-deposit, other classification. No. 1 lakh crore asset size. Directly upper layer. And the top layer. Top layer is created to keep empty. Yes, top layer was created ideally to keep empty. However, if there is a potential, okay, systemic risk from a specific NBFC, okay. Now, what is this risk we are talking about? A risk which is kind of, if this NBFC fails, then it will impact the entire economy, market very badly. Okay. Unavoidable danger is there with respect to the economy and the market. That means if this NBFC fails, the entire economy or the entire market will suffer a lot. If that kind of NBFC is there and there are potential risk in that NBFC, they will classify that as a top layer. Clear? So ideally, it should remain empty, but in very rare scenarios when there is a higher risk to the level of market crash because of a failure of an NBFC, that NBFC will go into the top layer. So this is your scale-based regulations classification: base layer, middle layer, upper layer, and the top layer. Again, this classification is based on the layer, but how to identify a layer? Based on the activity plus asset size. Either you go for the activity, either you go for the asset size. Okay. So if P2P, account aggregator, NOFHC or type 1 is there, it will be base layer. DCIC, IFC, HFC, middle layer. Okay. Remaining will go to the your separate categories based on the asset size and everything. Okay. Again, top layer kind of, and let's say for example, if there is an NBFC, which if it fails, like if it becomes bankrupt tomorrow, it can impact very badly to the Indian markets and the Indian economy. And there are signals that, that NBFC is not performing well. That NBFC will be thrown in the top layer. So usually it should remain empty. That means no NBFC should be classified as a top layer NBFC. Only a NBFC where there is a higher risk of the bankruptcy or a failure or issue, which can impact the Indian markets and Indian economy very badly, public at large, that NBFC will be classified in the top layer. Clear? Any doubt? Very good question, Manish. Okay. So now everywhere we discuss, I was about to come on that particular point. Everywhere we discussed about the asset size. Okay. Everywhere we have discussed about the asset size. But the question comes is how we are required to calculate this asset size. In order to calculate this asset size, what we are required to include and what we are required to exclude. Okay. Is there any criteria given that how we can determine the asset size of each of the NBFC? And answer is yes. So there are criteria given that how to calculate the asset size, what to include, what not to include. Okay, and we will come on that in a while. Okay, we will come on that particular part, that how to calculate the asset size. But before we go on to that, any other doubt? Any doubt till now apart from this? Okay. When I talk about the asset size, okay, and we will see various terms on the capital, because we need to also understand what is the net on funds. We need to also understand what are the assets, how to calculate the assets. Okay. So when I talk about the term asset size is required to be seen as per the latest audited balance sheet, the total assets that we are required to consider for this. Okay. So in order to calculate the asset size, you have to see the latest balance sheet available of that particular NBFC and the total assets in that particular balance sheet which is given. The total asset which is given on the asset size of that particular balance of that particular NBFC. So you have to go for the audited financial statements, and whatever asset is given over there, that you have to take as the asset size. Okay, in order to calculate what are the total asset of that particular NBFC. Okay, somewhere, let's say for example, if there is a CIC, that's a core investment company. Over there, we have to see combine the asset of the groups, and there are other different direction. We'll not go into that. It's not applicable in that much detail, the CIC one. But I'm just saying that over there we have to see the asset at the group level also. So we need to total up all the assets when we are required to check at the group level. But that is again based on the financial statement, audited financial statements. Clear? So when I say asset size, it is based on the audited financial statement. I hope it is clear. Any doubt? Any doubt till now? Okay. So I hope it is clear. So can anyone tell me quickly what will be there in the NBFC base layer? Quickly, what will be there NBFC base layer? Which NBFCs you are going to include in the base layer? Quickly, can anyone tell me? Yes, Kanaya. You can try to unmute yourself if possible. Otherwise, you can write in the chat box. Very good, Manish. Yes. Very good, Radha. Yes. Very good, Ravindra. Very good. Yes. Absolutely correct. Very good, Manish. Yes, Kanaya. Very good. Okay. You can write in the chat. Not an issue. Very good, Ravindra. Yes, absolutely correct. So, as we discussed, based on the classification, asset size, non-deposit taking, asset 1,000 less than 1,000 crores, peer-to-peer account aggregator, NOFHC, and the type 1 NBFC. Okay. Now, let's understand a bit on to the type 1 NBFC. Now we will go towards the type 1 NBFC to understand. See, till now what we have understood is that a particular NBFC can be classified as an upper layer, base layer, middle layer, okay, and based on the activity. Now, what is this type 1 NBFC, from where the type is coming. Either it should be asset, either it should be layers, either it should be activity. Now, from where we are bringing the type into the picture? Okay, from where we are bringing the type into the picture. So basically, the type 1 NBFC, there is a separate classification for that. There is a separate classification for the type 1 NBFC based on how that, like, what is the role of that NBFC and why. I will explain why this classification was given. And this classification of type 1 and type 2 again goes on the asset size only. So if you have understood the asset classification based on the asset size and the deposit, on that level, on that line only, the type 1 classification is provided. Okay. So just let me show you the type based classification. Okay. Basically, when I talk about type based classification, okay, that type based classification is based on customer interface and availing public funds. The way we discussed about the deposits, okay, similar to availing public funds, and customer interface of one new area that we have brought into the picture. Now, if a particular NBFC is having asset size less than 1,000 crores, already base layer, okay, so NBFC which is going into the base layer, plus it is not having any customer interface, plus not availing public funds. Again, three conditions: asset size less than 1,000 crores, not availing public funds, and not having any customer interface. These NBFCs are exempt from the registration. Okay. These NBFCs are exempt from registration. And why we are understanding the exemption is because the NBFCs which are not getting qualified for the exemption, okay, will go in the type 1. So basically, non-deposit taking with no public funds, no customer interface, asset size below 1,000 crores are unregistered type 1. Means they are exempt from the 45 IAIC of the RBI Act. They are not required to get registered. Perfectly fine. The moment you breach the asset size, that means you are not accepting public funds, you are not having customer interface, but you have an asset size more than 1,000 crores. So now we are changing the asset size, means your asset size has increased. Now you need to go and obtain the type 1 registration. Okay. So to understand the type 1 registration, we need to understand who are not required to obtain registration. And the moment you cross the criteria, the layer, you will get to register. So type 1 and type 2. I'll come to type 1 and type 2. Type 1 and type 2 NBFC. But you'll say, sir, where is type 2? We have not discussed type 2. Wait a minute. It will come. Don't worry. So let's say, for example, when I talk about exemption, okay, and exemption I am classifying on 3 criteria. That is no public funds, or basically public funds, then customer interface, and asset size. So on these 3 criteria, I will determine the exemption. Public funds, if you don't have, no, fine. If you don't have a customer interface, okay. If your asset size is less than 1,000 crores, rupees 1000 crores, then you are qualified for the exemption. You need to satisfy no less than 1000 crores. The moment I change one thing, that is type 1. So still public funds no, customer interface no, but the moment I have a asset size more than 1000, I need to opt in. I'm now shifting from the exemption to the type 1 registration. This requires registration. Remember, this requires registration as per type 1 or as type 1. Okay. You are not having public funds. You are not having customer interface. Your asset size is less than more than 1000 crores. Go for registration of type 1. Okay. Now type 2. Type 2 is a category, or rather than the residuary category. Type 2 means that here doesn't make any difference whatever asset size you have. You have breached the requirement of basically public funds. So if you are taking public funds, if you are taking customer interface, okay, yes, doesn't make any difference. This one, irrespective of the asset size, you will fall under the type 2 category. So if either of this is yes, either of this is yes, okay, in that particular case, you will go for type 2 registration. You will go for the type 2 registration. Now, when I talk about type 2 registration, there is no as such type 2 kind of. Okay, you are not required to go and say, okay, I'm type 2 registration. I need to obtain the NBFC type 2 registration. But over there, you need to see, are you falling any under category of other categories? Like, are you, obtaining basically providing any other activity of the services? If yes, then you need to see whether you are availing public funds, you are having customer interface, and what you are doing. Based on that, your registration will go. If nothing is, if you're not falling any under category, then you may go for plain type 2. But let's say, for example, if I'm availing the public funds, that means I'm accepting the deposits. So I'll be NBFC accepting deposit, and by this way, I will be NBFC D, and it will take me to NBFC middle layer. If I am having customer interface, so what is my activity? Why I am having customer interface? Customer interface means people are coming into my offices for the NBFC's offices. I'm meeting the people or the customers on day-to-day basis. There is interaction between the customers, which is the normal public outside. Okay, so there is a customer interface. So if there is a customer interface, you need to understand why it is, what the activity it is, and accordingly what classification it falls under. Okay, if you are accepting deposit, by default it will go to NBFC D and NBFC ML category. So basically type 2 is kind of a residuary category. If you do not fall under the type 1 exemption or the type 1 registration, you go for the type 2. Okay, so either it is type 1 exemption or the type 1 registration. If you are not into the type 1 exemption, type 1 registration, you go for the rest of the residuary category, which is a type 2. Clear? So either you will be, or if I talk about the appropriate term which is there, it is unregistered type 1 and type 1. So when I talk about unregistered type 1, it is the exempt one. And when I talk about type 1, it is the registration requirement. Okay, registered type 1. Unregistered and normal type 1. So that is unregistered is exempt, and type 1 normal one is the registered one. And this is evident. We will see exemption requirement. So there are, I will show you something. See over here. So exemptions from the section 45 IA, IB, IC of the RBI Act. Okay. Exemption from 45 IA, IB, IC of the RBI Act. And if we go down onto this, see, NBFC not availing public funds, not having customer interface. It operates without public funds, without customer interface as their long-term business model. Asset size is less than 1,000 crore as per the latest audited balance sheet. Passes an annual board resolution at the beginning of the financial year that will not avail public funds and will not have customer interface. These are exempt from registration, that is exempt from section 45 IA registration NOF, IB specific requirements in the IC of the RBI Act. Basically, they are outside. They have been kept outside the registration purview. You are not required to get registered. But along with that, there is one important thing that you need to note. Is the disclosure requirement. You need to disclose in the notes of accounts that you are the unregistered NBFC. So this comes with the disclosure. Exemption, fine. But type 1 requires disclosure in the notes to financial statement. I'll say star mark, and over here, NBFC exempted. Okay. Type 1 is required to disclose in financial statement as specifically unregistered NBFC, unregistered type 1 NBFC. Okay. Unregistered type 1 NBFC. This is mandatory if you are obtaining the, if you are going for the exemption. Okay. Plus board resolution and all these things are required to be followed. From here, see, we started with the base layer. From there, we went to the type 1 and type 2, and we understood the exemption requirements. Okay. This is how the type 1 is linked. Any doubts? Any doubt? Yes, no? Why it is important to understand? Because these NBFCs are now not required to get themselves registered, and they are not required to maintain the net owned funds. This will take us to the next discussion point, which is the net owned funds. Okay. So now we will proceed to the next requirement, which is the net owned funds requirements. Okay, there is one doubt. NBFC classification so as to also account for the same and to audit with its use. Yes, absolutely. So NBFC classification will also, impact auditing purpose, like auditing requirements also, and we will see how. If amount is net 1,000 crores, then see, if the amount is your exactly 1,000 crores, then what you will do? Okay, very good question. Okay, edge line case. That means not a penny here and not a penny there. Okay, fine. Now, if you see the way it is being classified, if the asset size, aggregate asset size is 1,000 crore or above, or if you see, when I talk about registration, the registration requirement specifically says less than 1,000 crores. If it moves rupee 1 also, if I move more than 1,000 crore, that means even 1,000 crore and more, because less than is covered into the exempt. If it is 1,000 crore or more, it will go into the category of the registration. So then you go for the type 1. So if it is aggregate size is 1,000 crores or above, then you are required to get registered as a type 1. Clear? So I will write over here more than or equal to. Okay, more than or equal to 1,000 crore, you are required to get registered, because everywhere the exemption we are talking about is less than 1,000 crores. The term and the terminology used is less than 1,000. That means 1,000 and above will go to the that side. Even if you see in the base layer, we are talking about below the asset size. But if you see in the middle layer, 1,000 crore and above. So even a rupee more, like 1,000 crore or more than that will go into the middle layer, which requires your registration. No, it will not be type 2. See, type 2 or other category will come into the picture when you are having customer interface and public funds irrespective of the asset size. That means for the type 2, asset size is not important. Even if you have a less than 1,000 crore, but you are availing the public funds and you have a customer interface, you will still go for the type 2. Okay, so the type 2 is primarily based on the public funds and customer interface irrespective of the asset size. Clear? Any doubt? Okay. Now we will proceed to the next part, is the net own funds. Very important part, because based on this we will decide what net own funds a particular NBFC is required to keep. Okay. Now I hope you have gone through the last discussion or whatever we have last discussed in the previous session. Can anyone tell me why NBFCs and from where the net own fund requirements is coming into the picture? Where it is written about the net own funds? Where it is specified that the NBFC should have a net own funds? Anyone? Definition. Let's go to the RBI Act. It is not into the definition. It's into the section 45 IA. Okay. Section 45 IA talks about requirements of registration and the net own funds. Okay. So section 45 IA says that no NBFC shall start its operation or shall commence and carry the business of an NBFC. Now, business of NBFC, again, this is coming from your 45 IA, which point out to the 45 IF and 45 IC, okay, which is financial institution and all those things that we have discussed. So that is the business of NBFC. Whatever is specified in the F and C is your NBFC business. Okay. Now, if I talk about that, no banking financial company, no NBFC shall carry on the business of NBFC without obtaining a certificate of registration. So you need to obtain the certificate of registration, and without having the net own funds of 25 lakh rupees or such other amount not exceeding 100 crore rupees as the bank may by the notification specify. So something between the 25 lakh and 100 crores. But if there is a notification, then you need to follow that. And the notification is nothing but these 2025 directions. So the net own funds provided in the 2025 directions are the required to be followed, which are between 25 lakhs and the 100 crores. So 45 IA says that have the COR and have the NOF as prescribed then only go and carry on the business. Otherwise, do not carry the business. So to have the business, minimum requirement is that you have the COR and NOF. That is necessary for the business. So business of NBFC will require these two conditions to be fulfilled. Otherwise, you cannot carry on the business of NBFC, irrespective of the asset size, irrespective of the classification, irrespective of anything. Doesn't make, that will not come even into the picture. The base layer, middle layer, upper layer will not even come into the picture if you do not meet these two criteria, because you cannot commence the business. Okay, so NOF is required, certification of registration is required before you carry on the business. Now, one important point. This is not applicable to unregistered type 1 NBFC, because they have an exemption from 45 IEA. So they don't need a certificate of registration. They are not required to maintain NOFs, net own funds. Clear? Pretty much straightforward. Now you understand from where we are coming, the unregistered type 1 to the registration requirement of 45 IEA and the net own funds. How everything is connected. Clear? So if it is an unregistered type 1, they are not required to register, they are exempt. They are not required to fulfill the requirement of the certificate of registration. They are not required to fulfill the conditions of the net own funds. So whatever now we are going to discuss for the net own funds, keep the unregistered type 1 NBFC out of it. Provided, no, there is a question. So anyone can carry the business of NBFC irrespective of the NOF. But you forget one thing. What is the business of NBFC? Lending or accepting deposit? Yes or no? If you accept deposit and if you lend, that means, let's say for example, if you accept deposit, you directly go into the type 2. If you accept deposit, you directly go into the type 2. And if you lend, that means you are availing public funds or you are having customer interface somehow. Okay, let's say if you are lending to people, that means you are having customer interface. Again, you will go to the type 2. Again, you will go to the type 2. So if you are carrying the business of NBFC, if you are carrying the business, that means you will have the customer interface, you will have the deposit, you will have the public, you will avail the public funds. So this exemption is not applicable to you. Now then, for whom this exemption is applicable? For those entities who are not carrying on the business of NBFC, not as per the definition on the real ground. We are talking about the practical scenarios. Okay. So let's say there is a company which is a family office. They are having the assets of their shares of their group companies. Now, when they have shares of their group company, they will meet the criteria of principal business 50-50. That means their 50% of their total asset will be the assets from the financial assets, and the income from those will be more than the 50% of their gross total income. Okay, gross income. That means they will fall under the category of principal business criteria and they will be required to get registered. But they were never a NBFC. They are only a holding company for the shares of their subsidiary companies. That's a family office or a holding company. Those companies which are small, not having customer interface, not availing public funds, asset size below 1,000 crores, don't come to us. Don't get yourself registered with the RBI. Okay. carry on your internal business or internal structuring thing with that particular entity, even though you classify for the principal business criteria. That's where this registration requirement came into the picture, not for the NBFCs, which are actually in the business of NBFC. Okay. So it is very edge case scenario for certain companies who are getting classified as an NBFC, even though when they were not doing the business of NBFC. Otherwise, on ground, if you are doing the business of NBFC, this exemption is not going to be applicable to you. So don't worry on that. Okay, now coming to the net on funds discussion that we were having. So what is net on funds? Now, as we saw already, clause B of subsection 1 of RBI Act 45 IA. Okay, the RBI can prescribe the net on funds. Okay, and has specified the net on funds of 10 crores. Remember that. Net on funds of 10 crores required by, okay, and this is required for NBFC, ICC, MFI, and Factor to commence on and carry the business of non-banking financial institutions. Then comes to the NBFC peer-to-peer lending account aggregator, or NBFC, having the type 1 NBFC registration certificate. They are required to have the net on funds of 2 crores. Okay. NBFC, IFC, IDFC, and NOF. Okay. They should have the NOF of 300 crores. Yes, 300 crores. There's a specific requirement for them. They should have an NOF of 300 crores. Now you will say, sir, how they can prescribe more than 100 crores? In Act, they are bypassing the Act. It is not. There are other provisions in the Act which allows them to set up more NOF. So that is there. So these are specific kind of NBFCs where they have the power to set up higher NOF. Okay, so don't get confused on that particular point. Again, ICC, MFI, and the Factor are having the NOF of 10 crores, but that is by the 31st March or 31st March 2027. By 21st March 2077. And what is this? This is known as a glide path. And I'll tell you the purpose of this glide path. See, your glide path, okay, this is 2025 and this is 2027. Let me take you to a bit of old glide path. Before this, there was a glide path. I'm just, for your understanding, I'm taking you to that. Now, before this glide path, why this glide path is there into the picture, there is a reason behind it. The reason is a scale-based regulation, old one, 2023. Okay. Now, what happened in 2023 when the new regulations came into the picture? Okay, when new regulations came into the picture, at that point in time, all the NBFCs were following 2 crore criteria. All the NBFCs were following the 2 crore criteria. No, we will follow like what was there, 2 crore in old scale-based regulations. Now suddenly you bring up something new in 2023 and you say, no, you are 10 crore. Okay, you cannot do that basically. That means tomorrow, one morning I'm saying, okay, your net on funds criteria increase from 2 crores to the 10 crores. No one will be able to meet it. No one will be able to meet it because that would create a huge problem for everyone. Huge problem. Overnight, they have to jump from the existing 2 crore, which was there in the 2023. This is old, by the way. This is old. Old, 2023. From existing 2 crore criteria, okay, in 2023, I cannot say them, okay, go make 10 crore overnight. Not possible. That's why RBI came and said, don't worry. Okay, we expect you to maintain 10 crore, but not today, by 2027. So RBI said in 2023, we understand that you are on 2 CR. But what you do is by 2025, bring it to 5 CR, and by 2027, make it to the 10 CR. So we are giving you time to reach to the level of 10 CR. Not directly today on 2023, but we are giving you the time. This glide path, which was introduced in 2023, so that NBFCs can gradually increase their net own funds, has now reached to its end. We are standing in 2026 today. So next year, all the NBFCs are required to comply with this 10 crores. So the current NOF, that means this is 2023 position. 2023, when for the first time SBR was introduced. So it was asked, okay, now you are 2 crores. So MFI and factor increases to 5. ICAI, ICC, keep it to 2 crores. But by 25, bring it to 577. And then gradually, when you reach to 2027, everyone will come to 10 CR. Now, this is specifically applicable to these 3 categories. For the rest of the category, is still 2 crores. Okay. As a result, when I talk about NOF, net own funds, as per section 45 IA, okay, 45 IA. If I talk about this particular section and NOF requirements, so there are 2 categories as of now I will divide. One is ICC, MFI, ICC, MFI, and your factor. This category is required to follow the glide path, and by 2027, this is 31st March 2027, they are required to maintain the NOF 10 CR NOF. They are required to maintain. Okay, through glide path. And I will write it over here. That is to be achieved through glide path. Now, there is another category of NBFC. Okay, we discussed. That is your P2P, AA, and type 1. Basically, which are in the base layer. Remember, base layer, we classified P2P, all these NBFC based on the activities. Over here, this one, P2P, AA, NOFHC, and type 1. Okay, type 1, that is means, now when I write type 1, this is registered. Type 1. Okay. Now, these NBFCs, which are coming into the base layer. So, NBFC coming into the base layer, they are required to maintain the NOF of 2 CR. Okay. Simple. Base layer 2 CR because they are small. ICC, MFI, factor, which is again, if you see these 3 NBFCs, ICC, MFI, and factor, somewhere they are either in the middle layer or they have their own set of regulations. They go for the 10 CR. Okay. And if there are different also, like IFSC, IFD, they have a 3,000 crore, but we will not go in that. But if you want, these are the funds, basically fund-based NBFC. Let us write also, which is IFC and IDF. These are the fund-based. So because they are the fund, their NOF is more than normal limit, which is 3,000 crore NOF. 300 crores, sorry, my mistake. 300 crore NOF. Okay. So this is how the NOF requirement follows. Through the glide path, for the three. These three have the glide path. Rest, they don't have the glide path. Okay. Now there are specific NOF requirements. That means this is the general we have discussed, but there are specific NOF requirements. For example, HFC. So there is a direction of HFC which has their own NOF requirement. P2P, they have their own NOF requirement. AA, they have again own NOF requirements. And I'll show you just for an example the AA one, account aggregator. The reason because see these when I talk about different set of NOF requirement, that is over and above the general one 2 CR. That means they are now required to follow something additionally over and above, like the NOF that a general regulations give. So these category wise, they have these specific regulations also. You are not required to go in that much detail, but just this is for your understanding purpose. Okay. So you are not or you are not expected to go to the accounts aggregator regulation and be understood with everything in that. This is just for understanding purpose. So when I talk about account aggregator, okay, and it is specifically if you see paragraph 11 and 12, I'll just show you paragraph 11 and 12, nothing else, so that you can understand what is the requirement over there. Basically, paragraph 11 talks about the registration requirement, and paragraph 12 talks about operational requirement a bit. So see, this is over there. Okay, that they need to carry on the business with, they should not be carry the business without the certificate of registration. Net on fund should not be less than 2 crore or such higher amount as may be prescribed. Okay, 2 crore at the time of seeking registration. So every separate regulation have this criteria. They may have something else also apart from this. Okay, so this is just one example. Okay, I'll remove it because we are not required to go in this much detail for all the NBFCs. This is for your understanding. They may have a separate requirement how to calculate for NOF, or is there any additional requirement with respect to the NOF. So that is applicable. Okay, but we will not go in that detail now. Again, one more thing I just want to highlight is this NOF is required to be calculated based on certain parameters. We will see that in some time, but as of now, just understand the calculation of NOF. We will dwell in certain time, okay, in some time, but this is required to be calculated based on the given formula. And once you calculate on the based on the given formula, then you need to see that NOF is being met or not, and then go for the registration. So that means at the time of registration, you need to comply with this NOF requirements. If you go to the RBI Act, we discussed the RBI Act. Okay, that means before commencing the business, at the time of registration, you should meet this requirement. Clear? Any doubt? Any doubt? There is one doubt which is being asked. If they don't meet the requirement, then what? If they are not able to meet the requirement, NOF requirement, then what? Basically, if you are not able to meet the NOF requirement, you will be penalized. Okay, you are not required, then you are not allowed to continue the business. That means NOF requirement is mandatory to meet. It's not something that you can meet later on or not. No, you have to meet the requirement. If you are not able to meet the requirement, that means you are not eligible to continue the business. And for that also, we will go to the act to understand it, because that has an importance. NOF has an important. Okay. So When I talk about the requirement of the NOF, and if they are not able to meet, just let me show you. Yeah. Okay. See, like when this first amendment came in 1997, this was part of the act itself that if a NBFC have a net own funds less than 25 lakhs, okay, or any such number which is being prescribed by the RBI, then for the 3 years from 1997 they were allowed to commence on the business and they carry on the business, but provided that they shall meet the requirement, otherwise they are not allowed to carry on the business. So one time exemption in 1997 was given. Apart from that, no NBFC is required, is given any exemption. Every NBFC has to comply with this NOF requirement. Otherwise, you cannot commence or carry. Not even start. Commence means start. Carry means ongoing. If your NOF is not there, you cannot carry on your business also after the commencement. So commence or carry your business. That is given under the 45 IA of the Act itself. If it falls below, you cannot carry. Simple. But the question comes is when we are required to check. Are we required to check NOF every time, every day? Or are we required to check the NOF on a particular time? That is very important. Okay. So the NOF requirement which is there, it's not required to be checked on a daily basis. Understand that. NOF requirement, we will see when we will go to the section of the reporting. At that point in time, we will see that NOF is required to be measured at the year end. Okay. If NBFCs are failing to achieve the prescribed limit, then they shall not be eligible to hold the certificate. But the prescribed limit is required to be monitored at the year end. Every year end. Okay. So every year end, you are required to monitor, and auditor is required to check, are you meeting the requirement of the NOF? If yes, you will be able to carry. If no, you are not allowed to carry. Simple. Okay. So during the year, you may have a fluctuation, perfectly fine, not an issue. But at the year end, this is not something that you can, allow. Every NBFC is required to have that level at the year end. Yes, Radha, absolutely. So it was like brought, this NOF requirement was initially brought in 1997. Okay, now let's understand the definition of this term. Let's understand the definition of this term. Net own funds. Again, this is given in this section only. For the purpose of this section, net own funds means this. Okay. What is required to be included, what is not required to be included, they are very good. They are given directly. And that has to be calculated based on the formula. Now, understand one thing. This is very important to this formula is required to be understood in an appropriate way. Because when I talk about this particular formula, this is if you miss one particular point, you may have a different answer. So if there is a question on the calculation part, okay, and if you misunderstood this formula, there could be a scenario or answer may come as a different answer. As a result, you need to make sure that you understand this formula appropriately. Okay. Okay. So what is net on funds? Net on funds basically is the aggregate of the paid up equity capital. Okay. So what RBI says how to calculate it is the paid up equity capital, first of all. Then it is free reserves. So you need to first calculate the paid up equity capital, free reserves, which is there in the latest balance sheet. And then you need to deduct something. You need to deduct the accumulated balance of loss, deferred revenue expenditure, and other intangibles. Let us write down. We will write one by one so that we can have our formula ready. Calculation of net owned funds. So the starting point was you need to have the equity share capital plus free reserves. Okay. You will get an amount. Now then what is happening? Once I have this level, then I need to deduct something. Once I have the aggregate of paid up equity capital and free reserves as per the latest balance sheet, and I'm required to reduce this thing, less this accumulated balance of loss, deferred revenue, and other intangibles. So we need to reduce these three items from the total of two. Less, sorry, not here, accumulated loss minus deferred revenue expense and other intangibles. Okay. So other intangible asset, we have reduced it. Fine, clear, straightforward, nothing difficult over here. Further reduced by, this is very important, a bit of complication. It has to be further reduced by investment in such companies in subsidiaries, companies in same group or other NBFCs. That means if an NBFC invests in other NBFC, this is to prevent the circular loop. What is circular loop? Let's say, for example, I started NBFC, let's say NBFC A, okay, A Limited. I provided the 10 crore funds in this. Now, what this NBFC did is, this NBFC invested in NBFC B Limited. So this 10 crore passed over here, and now this NBFC has a 10 crore shares worth of 10 crores. Fine. This NBFC has a 10 crore balance. Now again, I will start NBFC C Limited. This NBFC will provide this, and they will give him the shares of 10 crores, 10 crore cash. So it will get 10 crore cash. And if you see, if I just have this share transaction, nothing else, every NBFC will meet the NOF criteria. Why? Everyone has the equity capital or cash. But this is a single 10 crore, which is, going here and there. Now this NBFC A has a 10 crore at the end. This cash basically went over here. This cash went over here. So the final cash balance is lying in C. They have the shares of 10 crore over here, 10 crore shares over here. So everyone will have the fulfillment of the criteria. But in actual, there is only 110 CR, which is rotating between the NBFCs. Okay. That's why they came up with a concept. We will reduce the amount of investment, which is either into the subsidiaries, companies in the same group, or other NBFCs. So that if you have invested any amount in other NBFC, we will include that amount in the NOF of that NBFC, but not yours. Sorry, you cannot do the circular round transactions by doing this. Simple. So we have to reduce it. Okay, further reduced by investment in subsidiaries, okay, in group companies, and in other NBFCs. So whatever your net is there, that will be total investment, other investment, you can say total ineligible investment, that will be reduced from your total whatever amount you have calculated as of now, equity, share capital, and free reserves. Clear? Straightforward? Okay. Now, see, this is net on funds. Okay. There is one thing. Further reduced by amount representing investment. This is point number 1. So that has to be reduced. Point number 2, again, this has to be reduced. So this is also be required to be reduced. This is also required to be reduced. What is required to be reduced? Book value of debentures, bonds, outstanding loans and advances made to or deposit with subsidiary companies, same group companies, to the extent such amount exceed 10% of A. To the extent such amount exceed 10% of above A. Above A means this one, aggregate of paid up share capital. So this is something, if this exceeds 10% of equity plus reserves, free reserves, okay, then minus the excess. Minus the excess. That's what it means in simple terms. And why it is done is because they said that if you are not giving equity as an investment, perfectly fine. But if we'll give you as a, if you pass on the funds as a way of loan, debenture, bonds, we will only allow 10%. Means a NBFC can only allow 10% investment into other NBFC to make sure that you are not doing this, round circular loop. So 10% fine. Anything beyond 10%, not part of your annual. Simple logic. Anything beyond 10%, not part of your annual. So what I will do is, first I will calculate by way of loan, deposits or advances, bonds, in what? In subsidiary and the group companies. Remember, now what they are here saying is subsidiary and the group companies. We are not talking about other NBFCs as of now. So other NBFC is not part of this deduction. So value of debenture, bonds, outstanding loan, advances for the subsidiaries in the same of such company and the group companies. In subsidiary and group company. Okay, so I will first calculate this amount. Let's say this amount came to hypothetical 100 rupees. Hypothetical example. Okay. Now I will calculate 10%. What is allowed is 10% of equity capital plus free reserve, which let's say come to 50. Again example. That will be reduced from this. Okay. So minus from above. So net 50, this net 50 remaining will be gone out and will be reduced. Okay. Or let's say, to make it more understandable, I make it 40. So that then this will change and you will be able to understand what is going out. Let's say this is 40. So till 40 it is allowed, the rest 60 is not allowed. And this 60 will be reduced from this total over here. So this and then this 60 over here. Okay. This is how it will work. So let's say, for example, hypothetical example, this was the 10% was 40. So 100% will be 400. This is example. Let's say it was 400 and this other intangible and everything you reduce to, let's say, 100. Example. So your net amount is 300. Let's say this ineligible amount which is there, hypothetical example, is 50. Okay. So what will happen is 400 minus 100 minus 50. Okay. This is also minus. And now you have a minus 60. Example. Okay. As a result, the net will be your net own funds. So NOF based on above 400, 100 minus 300, 50 minus 250 and 60 or sorry 100, 50, 60. Okay. So the net own funds that will come will be 190. So this will be 300, 250 and 60 more. 190 will be your NOF. Now let's say this is in lakhs or crores. If I talk about, let's say, crores. So you are calculating the NOF in this particular way with the help of this formula. Okay. Clear? Any doubt? If I now, to simplify, this is step number 1. Calculate the equity and free reserves. Step number 2. Specific deductions. Step number 3. Okay. Which is group investment. Step number 4. Group loans. Then step number 5. You calculate 10% of step 1. And then on the basis of that, simple formula that you need to apply is that step 1 minus step 2, okay, minus step 3, and the net of, okay, and the net of minus net of step 4 minus step 5. So if you do this, you will get your answer. This is NOF. Simple. So the loans in the subsidiary and the group companies beyond 10% of your capital is required to be excluded. Clear? Any doubt? Any doubt? That is the calculation of net own funds as per the Act. So now you know how to calculate the net own funds. So confused in step 4 and 5. See, step 4 is calculate how much loans you are given to the group companies. And step 5, you see that how much of these loans are more than 10% of the share capital. Whatever more than 10% of share capital is there, you need to reduce that. That means first calculate 10% of share capital in step 5, take the step 4 and reduce it by the 10% of the share capital. And whatever outcome is there, minus it from the total equity capital and your NOS will be there. So step 4 minus step 5, that entire amount which will be there, step 4 minus step 5, the net result of that particular part has to be reduced from basically the entire calculation. Logic of this is that if you are doing any round tripping, if you are doing rounding of funds, by this way they will stop the rounding of funds and they will calculate the real net on funds a particular NBFC is having. So some may do a rounding of funds through loans, some may do rounding of funds through deposit. So to the extent of 10%, fine. Anything beyond 10%, please not allowed. In that way, you are required, that will be counted as a round tripping of funds. And that is not required to be calculated for the purpose of NOF. That is the logic. Any doubt? Any doubt till now? Thank you, Ravindra. Any doubt? No? Okay. If no doubt, then let's do one thing. Let's take a quick 10-minute break. After the break, we'll continue and we will see there are other elements of the capital also that we need to now understand. So we will jump and we will understand other elements of the capital and we will see why we need to understand that. Okay. So let's take a 10-minute break. Sanket ji. Sanket ji.
Yes, sir.
Break.
Break start, sir.
Thank you. Shall we continue? So, hello everyone, welcome back. Let's continue the session. So, what we have discussed till now, we discussed about the net own funds formula, which is given under section 45 IA. Any doubt with respect to that before I proceed further? Okay, if no doubt, fine. Again, anyone if you are watching from the YouTube, now you can join the session from start itself by logging to BOS portal with your credentials. Go to LVC 2027, May 2027. Then over there, you will option to join Zoom and you can join this session. Now you can join the session from start itself. No need to wait for the last 15 minutes. Again, if anyone is watching from YouTube, log into the BOS portal with your credentials. Go to May 2027 LVC. Over there, you will get an option to join Zoom and then from there, you can join this session. Fine. Okay. Now we understood about net on funds. Fine. Remember when we started this session, we discussed about something called registration part, like scale-based regulation and your exemption amendment. Okay, this is done. This is done. Now we are here. Minimum capital requirement, capital adequacy requirement, and one of such capital adequacy requirement was net own funds. But is there any other capital adequacy requirement? Answer is yes. There are other capital adequacy requirements for a particular NBFC. Okay. And that is, again, we have to understand from the perspective of the directions which is given. So let's go and jump the capital adequacy directions. Now, these are the capital adequacy directions which are issued by the RBI. Apart from the net own funds, we now are required to understand some other elements of the capital. Okay, some other elements of the capital. Why? Because net own funds is only one criteria for the capital maintenance. Apart from that, each and every NBFC is required to maintain some level of minimum capital. Okay, a minimum level of capital that is required to be maintained. Apart from net own funds, you are required to maintain a minimum level of capital. Now, that minimum level of capital is basically, you can say that, divided into three particular terms that we need to understand, and divided into three, you can say, topics. Okay. So these are the three topics that we need to understand the minimum level of capital. So the topic number one, that is your tier 1, tier 2. That is your first topic that we need to understand. Second is a risk-weighted assets that we need to understand because this is linked to the capital. And third is the capital minimum capital requirement, that is the capital adequacy ratio. Okay, which is usually also known as CARR, capital adequacy reserve ratio or capital adequacy ratio. Okay. Now, when I talk about capital adequacy ratio, to understand this, you need to understand what is tier 1 and tier 2 capital and what is risk weighted assets. Why? Because to calculate the capital adequacy ratio, you need to apply a formula. There is a formula that we need to apply to calculate the capital adequacy ratio, sorry, CRAR. So to calculate the CRAR, you need to total up the tier 1 and tier 2 capital and divide it by the risk weighted assets. Let's go to our notes back. I did a mistake over here. Just I'll rectify that it is CRAR. Okay. Now let's come over here and we will talk about minimum capital And in that, the first point is CRAR. Now, CRAR formula is pretty much simple. CRAR is equal to tier 1 plus tier 2 capital divide by risk weighted assets. Simple. Done. CRAR done. Now you'll ask her what is tier 1, tier 2. That's the important part that we need to understand. Okay. So tier 1 capital. Tier 1 basically is calculated based on a given formula. Again, there is the way we calculated the NOF, net owned funds. On similar lines, we have to calculate the tier 1 capital. Tier 1 capital is nothing but very good, Radha. Yes. Tier 1 capital. Okay. Now, again, when we talk about tier 1 capital or tier 2 capital, based on the layer, the formula differs. Okay. Now, tier 1, we are talking about NBFC primarily engaged in lending against gold jewelry and NBFC ML. These are the two categories we are now picking up. So a very small portion of BL, which is, lending against gold jewelry. If there is a NBFC which lends against the gold jewelry, and every ML, this is how tier 1 you should calculate. You take the own funds, then reduce by 10% of the own funds. Okay. Own funds as reduced by the following investment exceeding in aggregate 10%. Remember something we did step 4, step 5 in the net own funds? Similar. So own funds reduced by investment exceeding in aggregates of the 10% of the own funds, investment in shares of other NBFC, investment in shares, debenture, bonds, loans in subsidiaries and same group companies. Over there, we say 10% of capital. Here they are saying 10% of own funds. It is the same concept of the step 4, step 5. This is nothing but the step 4 and step 5. Similar to step 4 and step 5. Okay. And this is the first part. Then you add this. Add perpetual debt instrument issued by non-deposit taking NBFC. Okay. To the extent does not exceed 15% of tier 1 capital of previous year. To the extent does not exceed 15% of tier 1 capital of the previous year. Okay. So to the extent 15% it is allowed, otherwise it is not. Now we put into the formula. Tier 1 capital. You start with the own funds. Okay. Then you reduce the amount from the own funds, which is in excess of the 10% of the own funds, which is the investment in the same group company. So whatever the investment in shares and other NBFCs or investment in shares, debentures, bonds in the subsidiaries and same group companies is there, which is exceeding 10% of own funds, reduce it. So for that, I need to calculate. So I need to calculate just similar to step 4 of NOF. First, I will calculate investment in NBFC. Okay. then investment plus loans in group companies. Okay. Now this amount, let's say total other investment, is coming to this. Now I will less 10% of own funds. This is a similar, huh? This 10 own funds and this own fund, it's similar. So this one is this one only, which starting point. So I'm saying 10% of this. Okay. So whatever net amount I will get, this is the ineligible. Okay. Investment. This will go over here and this will be reduced. Simple. And this was something similar to step 5. Clear? Pretty much straightforward. Nothing difficult as of now. Now, we need to add something. Okay. We need to add, because it says comprises of the following. That means it's a total of this particular part and this part, perpetual debt instrument, to the extent not exceeding 15% of the tier 1 capital. Okay. So what I'll do is add. First, I will calculate perpetual debt instrument, let's say excess, 10% of tier 1 capital, 15% of tier 1 capital of previous year. So 15% of T1 of previous year. I have this another amount. And what it says that you can only allow to the extent of 15%. That means if it is more than 16%, that means it is not required to be counted. To the extent it does not exceed 15%. If it is 15% or below, I can include it. Otherwise, I cannot. So simple in this scenario, I need to say whichever is higher. Whatever is higher out of this, no, sorry, my mistake. Whatever is lower, whichever is lower. Whatever lower will be there, that will be added. And the net amount will be your tier 1 capital. So I will compare these perpetual debt instrument and 15% of tier 1 capital of previous year. And whichever will be the lower, I will be take it for the purpose of addition. If the perpetual debt instrument are less than 15%, fine, I will take it entirely. If the perpetual debt instrument are more than 15%, I will only take to the extent of 15%. That's it. That is my tier 1 capital. Now, that is for NBFC, middle layer and base layer with gold lending. Okay. So these are the two categories which are there. NBFC, middle layer, and BL, NBFC, BL with gold lending. If these are the two NBFCs, you calculate this way, tier 1 capital. Now, what about other NBFCs, which are base layer, but not lending against gold jewelries? If there is an NBFC who is not lending against the gold jewelry, then what about that? What is the tier 1 capital for that NBFC? In that particular case, let's understand. Tier 1 capital for other NBFC BL. And what we will do is this portion. Do not consider in case of NBFC BL other than lending against gold jewelry. Okay. If they are lending against gold jewelry, fine. If not, do not include this step. Ignore it. They are not required to consider perpetual debt instrument. Clear? Any doubt till now? Any doubt? So if it is the base layer, not lending against the gold jewelry, you are not required to include perpetual debt instrument in the tier 1. So it will be only this, similar to step 4 and step 5. Nothing else is required to be included. Only when it is lending against gold jewelry and ML, you include PDI. Okay? Only when it is lending against gold jewelry and ML, you include PDI, otherwise ignore that step. This is tier 1 capital. Now let's go and see the tier 2 capital. So tier 2 capital basically for the NBFCs will be as follows. Now, preference shares other than compulsorily convertible, that means optional convertible preference shares, OCPS, or non-convertible preference shares. So if it is not compulsorily convertible, either it's a non-convertible or it's optionally convertible, consider that. Revaluation reserve at a discounted rate of 55%. So you need to discount it at the rate of discounted rate. You need to take it discounted rate of 55%. General provisions, which is there for the standard asset, and the loss reserve, not attributable to the actual diminution in the value of the any identifiable potential loss, of specific asset, to the extent 1.25% of risk-weighted asset. So general reserve and loss reserve, unless and until it is specific. This, if loss reserve is specific, then do not consider. If it is not specific, okay, so kind of general loss reserve, then to the extent of 1.25% of RWA, you can include it. Okay. Hybrid debt capital instrument. Subordinate debt with a discounting. So if it is a subordinate debt, up to 1 year, like maturity of that particular subordinate debt, discounted 100%. 1 to 2 years, 80%. 2 to 3 years 60%, 3 to 4 years 40%, and 4 to 5 years 20%. But this subordinate debt to the extent discounted value does not exceed 50% of tier 1 capital and PDI in excess of what is qualified for the tier 1. So if there is a PDI which you did not include in the tier 1, which was not allowed, that is required to be considered in the tier 2. That is your tier 2. Let's write in the FAO formula. Tier 2 capital for NBFC ML. I'm writing it for the purpose like NBFC ML as of now. I'll explain why. Okay, and we'll start with simple OCPS or NCPS, that is the preference shares other than compulsory convertible. Preference shares other than compulsory convertible. Then revaluation reserve at a discounted rate of 55%. So revaluation reserve at the rate of 55%. This is a discounted rate. So you just multiply 55% and you will get the amount. Then general provision and general loss reserve to the extent of 1.25% of RWA. So what I'll do is general provision general loss reserve, okay, total general reserve. Now 1.25% of RWA, that is a risk weighted asset, whichever is lower, that will be counted for the purpose of tier 2. Simple. Then hybrid debt capital instrument and subordinate debt. So hybrid debt capital, now subordinate debt. Okay, subordinate debt is based on the discounting. This discounting is required based on the maturity. Whatever maturity is there, you need to discount it 100 to 20. But it should not, to the extent that such discounted value should not exceed 50% of tier 1 capital. That means whatever discounted value is there, it should not exceed 50% of tier 1 capital. So subordinate debt, let's say I have a discounted value. And I have a 50% of tier 1 capital. So whatever will be lower will be taken. Simple. Now I have to do discounting based on the table. So I'll just write over here. Discounting based on maturity, which ranges from 100% to 20%. Okay. So rate of discount, that means I'll apply the percentage and whatever value will come, I'll take that value. Means up to 1 year, 100% discount, I'll not take anything. Up more than 1 year, I have 80%, that means I'll only take 20%. So if I talk about value, it is 0, it is 20%, it is 40%, 60%, and 80%. That much amount I will take, that much value I will take. And rate of discount means I need to reduce this. Okay, so I said 20% discount means 80% of the value I will take for the subordinate debt. And then the PDI. Now, PDI basically perpetual debt instrument. Debt instrument. Let's say total value allowed in tier 1, that I have to reduce it, because already something, if it is allowed in the tier 1 based on this step, perpetual debt instrument minus 15% of tier 1 of previous year. So whatever amount I allowed this one, okay, is required to be considered over here. Now rest of the remaining amount, remaining, will be added, and the net will be tier 2 capital. Simple. Okay, so we started with the preference shares, revaluation reserve, general provision, hybrid debt, subordinate debt, perpetual debt instrument, and then you got your tier 2. Any doubt till this? Any doubt? No? No doubts? Okay. If no doubt, then let's understand for the base layer. So now let's understand tier 2 capital for NBFC base layer. See, there is not much difference when we talk about calculation of NBFC base layer and middle layer. There is only one difference. That difference is NBFC base layer is not eligible to include PDI in tier 2 also. So what I will do is I will go to this calculation, and this particular part, the last one, PDI, I'll take it up and I'll just say ignore in case of NBFC base layer. Simple. Then your calculation is ready for the base layer also. Rest everything same. Rest everything is also same. So this is how you are required to calculate your tier 1 and tier 2 capital. Any doubt to this? Any doubt? Now the question comes is, okay, sir, we understood the tier 1 capital. Sir, we understood tier 2 capital. Okay. We understood the CR-AR ratio. Perfectly fine. Now, what we are required to do with that ratio? Like if we understood, we calculate the tier 1, tier 2, risk-weighted assets, and the CR-AR ratio based on our this calculation. Now, what we should do with this? Let's say it comes to 10%, it comes to 12%, it comes to 15%. What is required to be done? So there is a minimum percentage prescribed that we need to see that whether it is being met or not. So basically, for NBFC, which is engaged in the lending against gold jewelry, it is required to maintain minimum tier 1 capital to risk weighted asset ratio, that is CR-AR of 12%. Okay. So NBFC primarily engaged in the lending against gold jewelry, tier 1 should be 12% and 15 capital to the risk weighted asset ratio, that is CRAR, should be 15%. So there are 2% which is given for your NBFC lending against gold jewelry. So now we will prepare a table for the minimum capital. Minimum capital ratio. Okay. So we will see when is a tier 1. One is another one is your CRAR ratio. Now, if the NBFC is involved into lending against gold jewelry, so NBFC, lending against gold. So tier 1 will go to the 12%. Sorry. And tier 2, the CRAR will go to 15%. Simple. NBFC lending against gold jewelry, tier 1 12%, CRAR 15%. That's a capital to risk weighted asset ratio. Now, there is one more condition, that the tier 2 of the NBFC shall not exceed 100% of tier 1. That means your tier 2 should not be more than the tier 1. So if there is any specific condition for tier 2, we need to see that. Tier 2 max 100% of tier 1 capital. Simple. Okay. That is for the NBFC lending against gold jewelry. For NBFC middle layer, the minimum tier 1 capital is 10%. And for NBFC middle layer, the minimum CRAR is 15%. And tier 2 capital shall not exceed 100% of tier 1 capital. So let's go back. Now we are talking about NBFC middle layer. So tier 1 is 10%. Okay. Tier 1 is 10%, which is over here. And the minimum CRAR is 15%, with tier 2 not exceeding 100% of tier 1. Again, this will be 15. And tier 2 max 100% of tier 1. Clear? Any doubt till now? Any doubt? No? Okay. Just for your understanding, okay, just for the simple explanation, for upper layer, I'm not going to the top layer. Top layer usually remain idle. If there is something top layer, they will see in detailed regulations way. We will not go to the top layer. Upper layer, NBFC upper layer. As of now, we will not go into this particular territory for timing, because we will focus as of now base layer and middle layer. Later we will see. Upper layer does not follow tier 1, tier 2. The concept of tier 1, tier 2 is not applicable to the upper layer. What is applicable to the upper layer is CET. which is common equity tier, which is not applicable to your middle layer, base layer, and all those. And when I talk about upper layer is required to maintain 9% of CET. Okay. And they have a separate formula to calculate the CET. That is the CET capital ratio is CET capital divided by risk weighted assets. And they are required to maintain 9% of the aggregate. As of now, we will not dwell into the CET for time being. We need to understand the base layer and the middle layer. Okay, but just for your information, this is how the upper layer works. Because from upper layer, regulation differs a lot. Okay. So tier 1 capital ratio, CRAR, the formulas are simple. Tier 1 divided by risk weighted assets is a tier 1 ratio. CRAR, tier 1 plus tier 2 divided by risk weighted assets is CRAR ratio. And this is how these NBFCs are required to maintain this particular level of percentage. Clear? Any doubt with this? Why we went into and checked that what is tier 1, what is tier 2, what is, how the tier 1 is required to be calculated, because this is something required to be maintained. And this is part of your capital. Otherwise, NBFCs are not required to commence and carry any business. Clear? Any doubt? Okay. Now, we will understand the next part, which is the risk-weighted assets. See, when I talk about risk-weighted assets, okay, it is pretty much simple. We are talking about the balance sheet items. And based on the balance sheet items, we will assign a risk rating to each of the balance sheet items. The moment we do that, we will get a particular number that will be the risk-weighted assets. Okay, it's simple based on the given table. So there will be a asset, there will be a risk number. So when I talk about risk-weighted asset, how to calculate? Simple. Asset, it will have a corresponding risk number or risk weight. Multiply both, you will get your risk-weighted asset. And by this way, you add all the risk-weighted assets, all the risk-weighted assets, you will get the total risk-weighted assets. Okay, simple. Asset multiplied by risk rate, not risk weight, nothing else, no complication. And this is how it is required to, be calculated. So I'll show you the table, and based on this table, we are required to calculate in this way. So if it is now see, it is again on the logical way. What is the logic over here is, if you are carrying the risk in your balance sheet, okay, you need to have a minimum capital in front of that, so that tomorrow, if something bad happens with that particular risk asset, okay, if something bad happens, in that asset due to the risk, you should be able to pay it off. As an NBFC, if you are, let's say for example, having some asset in your balance sheet, what are the asset? Asset can be, the loans given by the NBFC, deposits made by the NBFC, investment made by the NBFC. Because of the risky assets or the investment that you have, tomorrow if something happens, you should have enough capital to pay off the liabilities. That is the logic behind. The higher the risk in the asset, means higher the riskier asset, higher the capital you are required to maintain in front of that. That is the entire formula. Okay, so the tier 1, tier 2 capital divide by how much risk you have, and that should be the number, minimum 10%, 15%. So higher the risk, your denominator will increase, higher you are required to maintain the numerator, and so that you can have that 10-15%. That is a pretty much logic behind the risk weighted assets. Okay, so when I talk about cash and bank balance, is there any risk in the cash and bank balance? Is there any risk in the cash and bank balance? Yes or no? Quickly. Is there any risk in the cash and bank balance? Am I audible? Never. Yes, very good. So there is no risk in the cash and bank balance. That's why the weight assigned is to 0. So when you will multiply cash and bank balance to 0, you will get 0. Means you are not required to maintain any capital in front of cash. Why you will maintain? If you already have a cash, that means you are not required, you are not doing anything risky. You have a cash to pay off the liabilities. So no additional capital required to be maintained in front of the cash. Approved securities, government securities. Is there any risk in government securities? No, that's why 0. Bond of public sector bank. Public sector bank, again, government involved. And those are also bonds, debentures, which have a priority in case of, when the liquidation or anything bad happens. You are a secured lender under IBC also now. So very less risk, that's why 20%. Little risky, that's why 20. Okay, so you need to multiply with the 20, nothing else. Fixed deposits, certificates of deposits, bond of public financial institutions. It is now not public sector bank, they are the public financial institutions, and their fixed deposit is certificate. Normal. Okay, it's normal, that's why 100%. So whatever you have invested, maintain capital according 15% or 10% of that. If you will calculate the formula individually, means at least 15 to 10% you bring your own capital in front of that investment. Shares of all companies and debentures. Commercial papers of all companies and all units of mutual fund. Again, risky, 100%. Loan to high quality infrastructure projects, where the borrower has repaid at least 2% of the sanctioned project. High quality. It's high quality. That means it's a lower risk. Okay, it's a high quality, means a lower risk. So 75%. A bit of less risk. Loans to high quality infrastructure projects where 5% already paid. Okay, means the borrower already is paying 5%. That means he will regularly pay and it's a high quality. So still, I will say that it's a less riskier. Okay. Then stock on hire. That means you have given someone a hire purchase your stock, net book value. 100% risky. Intercorporate loans, risky, 100%. Loans and advances, fully secured against deposit. So you have a deposit with you and they are fully secured. There will be no risk because you already have a deposit. So 0. Loan to staff. Staff is a staff of NBFC. You can recover from salaries later on. They are working for you. 0. No risk. Other loans, other secured loans and advances considered good. They are other means given to other companies or something else. Riskier. Consumer credit exposure categorized as a retail loan, not housing, not educational, not vehicle, because in front of that you have some collateral. But I'm talking about retail loan, personal loan, high risky, 125%, more than what you have. So you need to maintain higher capital for that. Credit card, again, no collateral, maintain 125%. Bill purchased or discounted, 100%, because you have a risk in that. There is the risk of default. Asset leased out, there are assets which are given on lease. Because they are depreciable, you need to keep 100%. Same premises, furniture, fixture, 100%. Because of the depreciation. TDS. Is there any issue in the TDS? Is there any chance that you will not get the TDS? Zero risk. Advance tax. Is there any chance that you will not get the credit of advance tax? Zero. Interest due on government securities. Zero. There is no risk. Other current asset, other assets. Apart from this, if there is any other asset, 100%, because it's other category. We don't know. Again, fund-based claim on the central government. There is a claim on the central government. Zero. Direct loan or credit card or overdraft exposure with the government securities. Again, that's why zero. And then central government guarantees, zero. State government guarantees, okay, which have not been remained in default, 20, because there is no default, but state government is there. So still some risk is there. State government where there is default of more than 90 days means guarantee is there, but still they have defaulted. So 100% because there's a default. Okay, more than 90 days. So when you multiply the value of assets, you will get the risk weighted assets and you take this total. Okay, this is your denominator. You need to calculate the tier 1, tier 2, and accordingly you will get your answer of the minimum. That is how much minimum you are required to maintain. Simple. Clear? Any doubt on this? Any doubt? So that is the purpose of this entire exercise, to make sure that the NBFC has a minimum capital to pay off the liability and the risk in the liability. That's it. That's the minimum thing which is there. Now, again, as I said, there are multiple requirements for other capital, other things, sector wise, borrowing wise, borrower wise, specific NBFC requirements. Will not go to in that detail. We will not go into that detail because there is a detailed other requirements. This is just the start of understanding the capital, but there is multiple. If I just show you for your understanding. So once we understand, what happens after the risk weighted assets, there are other things also of balance sheet items, netting. Okay, then you have something called credit guarantee schemes, how they are required to be considered because there is a guarantee involved. Then exposure of the emergency credit line. 10 different things are there. Okay, treatment of balance sheet items which are not there in your balance sheet. Okay, then a lot of things are there. A lot of things, partially credit enhanced, complete credit enhanced, a lot of things are there of balance sheet market related items, risk, swaps, and 10 different things are there. We will not go into that detail because again, that is something specific scenario wise, if a particular NBFC has that and they are required to maintain in that scenario. Now there is a question, what comes under approved securities? Approved by Reserve Bank of India. So there are regulations on that, what is approved, what is not. If there are approved securities by the Reserve Bank of India, invest in that. You will have a zero. So not each and everyone will have a similar approved securities, what I understand, but approved securities, there is a list, there is a again detail given how much it is required to be maintained, the percentage and everything. Any doubt? So this is the minimum capital ratio, your tier 1, tier 2 capital, and risk weighted assets. So with this, what we done is we understood the capital adequacy. We understood the minimum part also, minimum part. So we are done with the capital adequacy and we are done with the registration. There is one question: why fixed asset is 100%? See, fixed assets are depreciable asset. That means tomorrow you need fund to replace those assets. Okay, that's why the 100% is assigned to those furniture, fixture, and let's say for example premises. Let's say for example, plant and machinery, land and building, and whatever it is. Now, in certain cases, again, you need funds for the repair and maintenance. You need funds for maintaining that particular premises. Okay, so for that particular purpose, 100% is required to be taken of that particular value. Any other doubt? Any doubt? Okay. So that was registration and capital adequacy that we discussed. The next part is IRACP, that is the income recognition, asset classification, and provisioning requirements. Okay. Again, we have a different set of directions, coming out of the SBR, scale-based regulations. So this is also earlier was part of the scale-based regulation in 2023. Now it's a different set of regulation. But again, it was a chapter in old regulation. Now it is the entire regulation itself. Just to show you, these are the old regulations. Okay. Everything that what we have discussed was part of this old regulation. That was in chapters. See, this chapter is on prudential regulation. Now we have a direction. So chapter taken out of it. Now it has become the separate directions. Non-banking financial companies, income recognition, asset classification, provisioning directions. Okay. So now it has a separate direction. Earlier it was a chapter. And if you see, it is same. Asset classification, provisioning requirement, income recognition, disclosure requirements. And if I show you this one, same. This is leverage ratio, tier 1. This is accounting standard, accounting for investments. Okay. Then income from investment, then asset classification. It was same. Now, just the part is, it is coming up in a different set of directions. 2025 directions. Okay. Let's understand what is income recognition, asset classification, and provisioning directions, why it is necessary. See, think one particular point is, you are the auditor of the NBFC. Okay. You understood now that when you are going to do the audit of the NBFC, whether the NBFC can carry and commence its business, because we understood the capital requirement. We understood whether the NBFC is required to obtain registration or not. Okay, based on the RBI. These are the starting points when you do the audit of the NBFC, and why you are required to understand that there is a standard on auditing which says you to understand that. Can anyone tell me which is that standard? Quickly. A standard, okay, on auditing which says that you understand these requirements. In fact, there are two. Registration. If I talk about registration, why I'm required to understand whether the NBFC is required to have registration or not? Quickly, which standard says that? Very good, Radha. Absolutely correct. I hope you have read about SA 250. What is SA 250? What is SA 250? Can anyone tell me the name? Yes, very good. Considerations of laws and regulations and audit of a financial statement. And over there you have a bifurcation. Yes or no? As an auditor, you are required to consider laws or regulation which have an impact on the entity. Now, again, we have a bifurcation over there. The provision of those laws and regulation which have a direct effect on the determination of the material amounts and disclosure in the financial statement. This is such law which is having a direct effect on the determination of the material amount and the disclosure in the financial statement. You are required to have the understanding of that. You are required to check whether there is a non-compliance with that particular law or regulation. Okay. Apart from that, there are specific reporting requirements for the auditor to report on compliance of these laws and regulations in case of an NBFC. So as an auditor, you are required to understand whether these laws are complied with or not. Okay, now when we talk about income recognition, asset classification and provisioning, this has a direct impact on your financial statement, because this talks about how you are required to recognize income. I'm not talking about Ind AS 115. There are separate income recognition guidelines which may override Ind AS. Now, quickly, are Ind AS applicable to NBFC? Are Ind AS applicable to NBFC? Yes. Very good. And which schedule is applicable? Schedule 3, part 3. Okay. So schedule 3 is also applicable now to particular NBFCs, schedule 3, part 3. So when that is applicable, okay, when these things are applicable over and above your Ind AS, if there is any specific requirement here that how you are required to recognize income, how you are required to calculate the asset, how you are required to book the provision, you need to follow. This will override your Ind AS, your financial reporting framework, and your schedule 3 if there is any specific requirement over here. That's where the role of auditor comes to understand this particular regulation. Very important. Yes, very good, Radha. So, Narendra, if you have any doubt, you can write in the chat box. I think, there is some issue with this, you're unmuting others. So if you have a doubt, you can write in the chat box. Okay. Now, under this particular regulation, we will understand the classification of the asset. We will understand the provisioning requirements. We will understand the income recognition and the disclosure requirement with respect to the base layer, middle layer. Okay. These are the two categories we will understand that how it is applicable. Because if you see, asset classification and the provisioning requirements will differ a bit based on the base layer and the middle layer. Okay. So now we'll start with the first asset classification. If you have gone through already with the chapter, can you tell me what is the asset? How do you classify the asset? Anyone? How do you classify the asset? No? Okay. No issues. Let me tell you. See, when we are talking about classification of the asset, we classify the asset based on certain categories. Okay. And all the categories, when I talk about classification, they work on the basis of a term called the NPA, non-performing asset. So to understand the classification, we need to understand the NPA. Okay. Let's go to our notes. Now let's start with the asset classification. Usually when I talk about the asset classification is into categories of standard asset, substandard asset, okay, doubtful asset, and loss asset. Okay, standard, substandard, doubtful, and loss asset. This is how I classify the assets. The entire classification works on a concept of the NPA. So to understand this classification is totally based on a term called non-performing asset classification. So once you understand the NPA, you will be able to understand the rest of the classification. Okay, so what is NPA? NPA means a asset which is, now again, remember we are talking about base layer. If there will be middle layer, it will work differently. When we talk about NPA means a asset which has remained overdue for more than 180 days. Simple terms, let's say this is the due date. Okay, now from this due date, if I talk about this particular date, which will be, let's say, 90-day period, from the due date to the 90-day period, 90 days, I will not classify anything as like, NPA or anything. So this is a due date and it was not paid. Let's talk about the due date of installment. So not paid, loan installment. Okay, and we are talking about simple loan, term loan. Now till 90 days, I will not do anything. But the moment 180-day period will get over, I will do something. Instead of 90, I'll take 180 over here. So it will be 180. And after 180, this term loan will be classified as a non-performing asset. Non-performing asset. So till 180 days, I'll not do anything. I'll not classify as a NPA. But after 180 days, it will become NPA. Once the loan installment is not paid for 180 days. That's what it means. Okay. Same, a term loan, inclusive of unpaid interest, which is outstanding for more than 180 days. Okay, overdue for a period of more than 180 days. Or a period of more than, it's not 180 days or more. It is more than 180 days. So everything happens after 180 days. So demand or call loan, again 180 days. Bill overdue, 180 days. Okay. So as of now, we'll take a general term of 180 days. Lease rental, 180 days. Any dues on account of sale of asset, 180 days. Overdue for 180 days. Okay. We are talking about 180 days. That is base layer. Now, remember 2023, SBR came into picture. So when SBR came into picture, RBI said, rest everyone is following 90 days. Why you are following 180 days? Let's streamline everything. But overnight, I cannot say you to classify 180 days to 90 days. That means if a particular asset or a loan which was overdue for more than 90 days but less than 180 days on 31st of March was perfectly fine. Next day when the SBR triggered, I cannot say this is NPA. Oh, now suddenly NPA. No, I cannot do that. So this 180 days, RBI said, okay, let's do one thing. I will give you time, change this requirement from 180 days to the 90 days, bring it to the down through a structured manner. And they came up with a glide path. Amazing glide path. So 31st March 24, we will consider NPA for 150, 25, 120, and by the end of 26, which is already gone, it will come to 90. So the glide path requires that, okay, that this 180 days will be considered now 90 days. That's why, in start I wrote 90 days. So that you cannot, like to avoid the confusion. So now this 180 day was before 2023, but as on 31st March 26, you are required to follow 90 days. You are required to follow 90 days. Okay. That means till 180 days, earlier I used to say that, okay, oh, it's NPA. After 180 days, I'll make it NPA. But now, based on the glide path, you have to reduce that time period. So if you are standing on 31st of March 2024, you will use the criteria of 150 days. Means anything overdue beyond 150 days, NPA. When you will come to 31st March 2025, you will say anything overdue more than 120 days will be NPA. But when you will jump on 31st March 26 and beyond, like the period after 31st March and 26, anything overdue more than 90 days is NPA. So before 2024, when that in 2023 SBR came into the picture, overdue or NPA started from 180 days and more. RBI gave timeline, reduced this 180 days criteria to 90 days in a phased manner. And that's where everything now is required to be considered 90 days for NBFC base layer from or as on 31st March 2026. Okay, as on 31st March 2026, this 180 day criteria has changed to 90 day. Simple. Clear? Any doubt with this? So if I say, if a particular NBFC is calculating before 31st March 2026, you need to apply year-wise criteria for the NPA calculation. But after 31st March 2026, 90 days. Don't go for any other period of 180 days, 150 days, 120 days. No. If it is after 31st March 2026, directly 90 days. Simple. Okay. Clear? This is how you are required to calculate NPA. Any doubt? Any doubt? No? Okay. There is one doubt from digital audit chapter. Okay. So the question is that because during my practical training, I have only audited accounting software Tally. Only I have never seen ERP system physically. So please clear my doubt. Second point is mandatory to watch lecture, watch earlier classes. Narendra, can you just write your previous doubt, because I have received this one only. I have not
What
received
is the query? Who is this?
Narendra Kumar.
Acha, what is he asking?
So I think he wrote he has not have he is not having any practical experience on the ERP systems other than the Tally. So he has some doubt on that particular point. And is it mandatory to watch lectures, earlier classes?
Yeah, earlier lectures, so they're available, so he can view the same. It's available on YouTube as well as on the app, right? So he can view those lectures. But right now, we are not in digital auditing and assurance. We are not addressing Taliwala issues.
Yeah.
Am I correct, Harshit?
Yes, ma'am.
है ना?
Hmm.
So, dear student, you need to read the chapter, go through the chapter. If you find any difficulty over there, you can definitely ask in the class. But we are here to talk about your curriculum. Okay, so whatever is covered in the study material or whatever is relating to that, we can discuss over here.
Yep.
And once you can just visit the lecture, you can review, you can go to the app, you can like watch the lecture on the YouTube. And still after reviewing, after considering that lecture and study material chapter, if you find any difficulty, that you can definitely ask.
Yep. So if you have
Okay,
any other
Naren?
doubt,
Yeah.
yeah. Yes, ma'am. No, please, ma'am. Uh, okay. So there is one more question. Why glide path needed to be introduced? So as we are concerned for provisioning, see, glide path basically was required so that overnight you cannot bring major changes. Like like for example, today I have provisioning requirements or NPA calculation from 180 days, and suddenly I bring it to 90 days. What will happen is the NPA will sudden jump up in my balance sheet, the NBFC's balance sheet, and because of that there will be a effect on the provisioning. Means you are required to make higher provisions, okay, because of the jump off of the NPA. And again, higher provisions, it will disturb your balance sheet, and it may not give the correct picture just because of a change of one regulation overnight. That's why the glide path was introduced. That's why RBI introduced glide path, so that provisioning can be adopted gradually with the change in the NPA norms. Any other doubt?
So are we going to ask some MCQs?
Yes, ma'am, it's there. So there is one doubt, sir. Is this condition of 180 days is for the term loans for from 31/3/2026? No. See, 180 days condition was before 31st March 2024. After 31st March 24, it went to 150. 31st March 25, it went to 120. 31st March 26, 90 days. So whatever 180 days we have seen over here, if you are standing after, if you are having, looking after 31st March 2026, this has to be understood as a 90-day. Okay, this entire thing has to be understood as a 90-day after 31st March 2026. Clear? Any doubt? Any other doubt? Okay. If no doubt, so as a quick revision, what we are going to do is we are going to take some small MCQs, okay, which will help us to revise the topic, whatever we have discussed till now. So these basically MCQs will help us in the revision of the topic, so that basically we can revise what we have seen till now. Okay, so let me quickly bring up those MCQs. I think there is some technical issue. Let me ask you the MCQs. Okay, tell me, for the NBFC base layer, okay, what is the asset criteria? If a NBFC has to be included in the base layer, what is the minimum asset criteria? Like, if it exceeds beyond that particular asset limit, it will not be counted in the base layer. So what is that asset criteria for the base layer? NBFC base layer asset criteria. Very good. Less than 1,000 crores. Okay. Now, for type 1 NBFC, again, type 1 NBFC, what is the criteria? I'm talking about registered type 1. So which NBFC will be falling under the type 1 registered? Which NBFC will fall under the type 1 registered? Yes, more than 1,000 crores. There are two more conditions. No, there are two more conditions if a NBFC has to fall under type 1 NBFC. Quickly. Public funds and customer interface. Yes, there should not be a public funds, availment of the public funds, and there should not be any customer interface. Okay. If a NBFC is not having public funds, is not having customer interface, asset size is less than 1,000 crores, whether that NBFC is required to maintain NOF, whether that NBFC is required to maintain NOF, it is not having public funds, it is not having customer interface, the asset size is less than 1,000. Is it required to maintain the net own funds? Again, there is no availment of the public funds, no customer interface, and the asset size is 1,000, less than 1,000. Whether that NBFC is required to maintain NOF? Not required to maintain. Yes, absolutely correct, because there is an exemption that we discussed. Unregistered type 1 NBFC. Yes? Okay. Quickly, what is the NOF requirement for base layer, NBFC base layer, NOF? 2 CR. Very good. Yes. Okay. In calculation of the tier 1 capital, for the NBFC base layer, what we are not required to consider? For the calculation of the tier 1 capital for the NBFC base layer, what we are not required to consider? Very good, Radha. I'll repeat my question again. For the NBFC base layer, in the tier 1 capital calculation, what we are not required to consider, which was considered in the middle layer? Your answer is perpetual debt instrument. Perpetual debt instrument are not required to be considered for the base layer, other than lending against gold jewelry. Yes or no? It is required to be considered in the middle layer. Okay, minimum capital ratio. So what is the minimum capital tier 1 ratio for the NBFC lending against gold jewelry? Very good, Radha. Anyone else? NBFC lending against gold jewelry, tier 1 capital ratio, minimum. What is the minimum ratio? %. We discussed that 12% tier 1, CRAR 15% lending against gold jewelry. And what was the criteria for the tier 2 capital? What is the criteria for tier 2 capital? How much tier 2 capital should be there for the NBFC lending against gold jewelry? Maximum 100% of tier 1. Yes, very good, Radha. Maximum 100% of the tier 1 is allowed, not beyond that. Okay. So I hope with this, you guys now have a good understanding of the registration, scale-based regulations, categorization, and the capital requirement. Again, before we close for the today's session, any doubt? Any other doubt? Narendra, if you have a general query, like if the query is related to the study material and the topic, you can ask anytime, not an issue. But apart from the study material or apart from the curriculum which is there, it will be difficult to discuss over here. So if it is something with respect to the study material and if something is, on the chapter side or anything which we are discussing, you can ask freely. So there is one query, why 55% discounting done in the revaluation reserve? There are reasons because, the nature of the revaluation reserve. Again, it's a different topic to discuss. I would, I would generally say that because of the nature of the revaluation reserve, it is required to be discounted at the 55%. So that is something scientifically calculated number that how much can be allowed, cannot be allowed. Any other doubt? No? If no doubt, then thank you guys. Thank you for participating in today's session. And
Thank you, Harshad sir.
Thank you, ma'am.
And thank you, dear all students, for the attending the session. And I hope you all are making your notes. And thank you so much to Harshad sir. And dear students, I hope you are able to understand that lot many amendments are there in this chapter. So please understand the concepts, provisions, capital requirements, which are explained by Harshad sir with the help of regulation notification. Tomorrow we will upload the notes also. Whatever is being covered till now, tomorrow it will be available to you so that you can revise also. And next class is on Wednesday, and that is going to be very, very important session. So don't miss any of the class because NBFC amendments are there. And if you are attending regular class, it will be easier for you to understand the same and make your own notes, right? Yeah, Akshat sir, would you like to add on something?
No, ma'am, you're pretty much covered. Yes.
So thank you. Thank you very
Thank you.
much. Thank you,
Thank
dear
you.
students. Yeah.
Thank you.
Sanket ji, class is over.